Joining us now is Chance Finucane, Chief Investment Officer at Oxbow Advisors. Chance, just let's look at the market today, how it closed amid this lackluster September jobs numbers. What are your thoughts?
Sure. Hi, Alicia. I think looking at the payrolls report today, what we're looking at is, was any part of that going to change what the Federal Reserve is going to do starting next month, where I think we're expecting that they will begin tapering their monetary stimulus. We don't expect that to change. What we're going to monitor going forward is going to be how fast are they going to taper, and then how long will it be before they start raising interest rates? If you look back at 2013, the last time we started tapering, it was 2 years to the month that we went from the beginning of tapering to the start of raising interest rates. So we're starting to look for that over the next year or two.
It's interesting because that was going to be my next question in terms of, do you think that today's report will impact the taper movement in terms of the Fed's timeline? You're saying you don't think so. Do you think that the market has priced in that November tapering, again, in lieu of these numbers being lackluster, and maybe some thinking that potentially that timeline would be moved?
It seems like conventional wisdom that everyone's expecting that taper to start next month. So it would be a surprise if they change their plans. But yeah, everyone also pays a lot of close attention to the wording and the phrasing of any announcements. So if they show more caution about how fast they're going to taper their way back down to zero monetary stimulus, or that they may be prepared to increase the stimulus at a moment's notice if they see trouble in the economy, that might change how investors are positioned.
Gotcha. In terms of understanding, where the market is moving, where it's going, or at least trying to understand it, what do you think are the major factors? Obviously, you're saying that most investors have priced in the taper for next month. We've got the debt ceiling at least temporarily resolved for a few more weeks here. What are the biggest factors that are going to be moving the markets, at least in the short term? And again, if you could even expand in the long term.
Sure. So the debt ceiling is something to pay attention to, but I think that's less of an issue. You expect that at some point they will come to, like currently, a temporary solution and then maybe a more permanent one that pushes things out a bit further. Besides the Federal Reserve, the other two areas we're looking at are the Delta variant's impact around the world. You saw daily new cases peak in August in a lot of countries, and now that's starting to come down. We think that's part of why some cyclical sectors have been outperforming since August. And then the other is the supply chain woes globally that are impacting and sparking inflation. And there's a number of different variables that are causing that, but one was the pandemic lockdowns in warehouses and ports in some of the countries in Asia that were dealing with the Delta variant. So if you see that cases are going to start coming down in countries like the Philippines, Malaysia, and Indonesia, that may improve some of the supply chain issues in that part of the world.
I'm glad you bring up supply chains. Obviously, it has been kind of something that's come to the forefront as being one of the biggest concerns, especially as we go into earnings season. You mentioned the impact that it has on inflation, but the Fed continues to have the argument that inflation is transitory, although we don't really have the definition for transitory, right? I think a lot of investors are trying to gauge that, and we're getting better as time goes on. In terms of, if we take the viewpoint that it is transitory, what's that timeline for transitory? Are we at the peak of the kind of bottlenecks with the supply chain, and will it be easing up? And what's that time frame look like?
It's really hard to say. I think the simplest way to view it would be that this is going to continue into 2022. We'll see how manufacturers and consumer goods companies perform trying to get their products through the holiday season over the next few months. But it doesn't seem like something that's going to go away anytime through the winter. So it's hard to know what the duration of that will end up being, but there are a number of factors that need to change in order for that to improve. So right now you've got a lack of containers, just trying to get shipments from Asia to other parts of the world. So you're actually having some companies ship their containers over to Asia empty in order to get them full at a higher price to get them back to the US or Europe. But that's actually leaving other goods that are coming through on railroads left waiting at ports trying to get over to Asia. There's all sorts of issues, and it's probably going to take at least through the end of the year and into 2022 before you start to see meaningful improvement.
Yeah, we noted yesterday companies like Walmart are even paying, private ships to kind of get their goods over as a form of potentially easing up their bottlenecks a bit sooner than others. And that's essentially the competitive advantage, right? I think right now, those who can manage these supply chain issues faster than others, better than others, without kind of taking major hits to the bottom line are the companies that people should be looking at. Correct me if I'm wrong there.
Yeah, I think you're right, even within a specific sector. So we saw Pepsi report earnings this week, and it's interesting for a company that has so many efficiencies and such scale, and they even reported inflation across just about every part of their business. And it didn't really impact their profit margins, but you saw it really impact the profit margins of some of their peers that are smaller and may not have the same leverage with their suppliers. So I do think that's something you need to monitor by sector.
Yeah, 100%. And we were just talking Tesla moments ago, and their delivery seeming to kind of outperform or manage the chip shortage a little bit better than some of the other kind of EV automakers, or at least right now in this short term. Want to get your thoughts on opportunities in the market, even amid the volatility and some of the concerns. You mentioned lingering concerns with the Delta variant impact, obviously supply chain issues and woes there, and then the Fed's plan to taper. Where are the opportunities?
When we look, we actually saw an opportunity a couple of months ago in cyclical sectors where they were starting to look undervalued and the defensive and growth areas were starting to look overvalued. And so we took advantage of that and bought a few cyclical stocks then. If you look now, the valuation gap between defensives and cyclicals have closed a bit, but we do still think there is some opportunity in the energy sector, especially if you're looking for dividend income. And that would be with MLPs, such as Enterprise Products or MPLX. These are companies that pay 7 to 9% dividends per year, and they actually have gotten much more disciplined in their capital spending. So they're generating a lot of free cash flow that can be returned to shareholders.
We look at the Nasdaq. The Nasdaq pulled back about 0.5% today, although it does end the week on the positive. And I think across the board, we still end the week on the positive. So we still made some gains this week, despite kind of some of the volatility. But in terms of the Nasdaq specifically, is this a case of buy the dip, even though there is that sensitivity to the taper?
It's really hard to time. You mentioned earlier the Treasury yields moving up, and that tends to be a negative in the last year or two for these tech growth stocks. But we do find that there are 3 or 4 large cap tech names that we think are undervalued. And we don't know that they're going to turn around and start going up tomorrow, but we think they're a good place to be if you're looking for growth for the long term. Those would be companies like Amazon, Alphabet, Facebook, and Salesforce.com, all businesses that are growing 15 to 20% a year and have zero net debt on their balance sheets.
When we look at companies like Amazon, Salesforce, Facebook, and Alphabet, I just think back to the last earnings report. Comparables were so tough. How do investors move forward in kind of, this next wave of earnings and looking at comparables, given that the pandemic tailwinds are just so hard to compare against?
I think for these companies, the compares are not quite as bad. But I think, Amazon, we've seen some expectations come down. Digital advertising has picked up a lot, which hopefully is a benefit for Facebook and Alphabet. Salesforce, a cloud software business like that, I think has just been strong straight through the pandemic. So it's something to monitor, but I actually think that through 2021, meeting earnings expectations, it's been surprising how many companies have been very positively on the upside on their performance when they report results. And that's usually not the case. So I think this might be one more quarter where you see some solid results. And then it'll be very interesting to see what companies are reporting for 2022 guidance when they report in January and February.
Before I let you go here, I want to get your thoughts on our correction. We've all been trying to time out this correction, which we will say is healthy for the market, that 10% pullback. Do you think we get it in October, which is kind of an ominous month? I know September is technically kind of the worst month we traditionally see, but October has its ominous kind of story along with it. And we do have earnings season that we know is going to come with a lot of mention of supply chain issues.
We don't ever try to predict what's going to happen over a 1 or 2 month stretch. I get that. I think we always want to have a list of stocks ready that would be willing to purchase if they fell to a certain price. And so that's usually how we take advantage of a correction like that. It's been a bit healthy to see this sort of consolidation period, but the market's really only come down about 5%, which is not enough to get really optimistic about opportunities that become available.
And that's a smart way to invest. I remind everyone to kind of have that list ready to go. When a stock gets below a certain point, you can kind of jump in instead of being scared of the market, jump in and take advantage of that opportunity. Really appreciate your insight and for being here. Chance Finucane, Chief Investment Officer at Oxbow Advisors.